Everyone, my name is Yasser Saeed. Welcome to the class of Financial Institutions and Markets, Econ 242. This is lecture number 14, and we will continue with the stock markets. Previous lecture, we studied the definition of the stock market. Then we studied the two instruments that are traded in the stock market, that is the common shares and the preferred shares. After discussing these two, then we moved on to the two types of market, the primary market and the secondary market. We have already covered the primary market. Now in today's lecture, our focus is entirely on the secondary market. Now, what is secondary market? Secondary stock markets are the markets in which the stocks when issued are traded, uh, that is bought and sold by the investors. The New York Stock Exchange, which is called the NYSE, and the National Association of Security Dealers Automatic Quotations, that is called Nasdaq, are well-known example of secondary stock market in the United States. In Pakistan, we have the Pakistan Stock Exchange. So we are going to discuss about these markets briefly. When a transaction occurs in a secondary stock market, funds are exchanged usually with the help of security brokers or firm acting as an intermediary between the buyer and the seller of the stock. The original issuer of the stock is not involved in the transfer of stocks or funds. In this section, we are going to look at the major secondary stock markets that again is the New York Stock Exchange, the Nasdaq, and then the Pakistan Stock Exchange. Major United States stock markets are the New York Stock Exchange, also called NYSE, and the National Association of Security Dealers Automated Quotation, which is called the Nasdaq. And prior to the acquisition by the NYSE in 2008, the American Stock Exchange was the third major stock exchange. Again, then we have another stock market that is called the Pakistan stock market, that is for the domestic stock exchange. So let us start with the New York Stock Exchange first. Now, worldwide, the New York Stock Exchange is the most well-known of all organized exchange. The exchange was created by the merger of NYSE Group Incorporation and Euronext, which was created from the merger of Paris Bourse and Brussels Exchange and Amsterdam Exchange in the 2000s. And then on April 2007, NYSE Euronext, which merged six cash equity exchanges in 5 countries and six derivative exchanges, is the world leader for the listing, trading in cash equities and equity interest rate derivatives, bonds, and the distribution of market data. So the merger was the largest of its kind and the first to create truly global stock market. Prior to this merger, in May 2006, the NYSE was public, allowing shares of the world's largest stock exchange to trade for the first time. So the offering followed NYSE's merger was publicly traded electronic exchange operators, which is called the Archipelago Holding, and NYSE Euronext Arca Edge. The New York Stock Exchange is the largest and well-known of the four, and NYSE Arca markets are both registered security exchanges for listing and trading of equities, fixed income products, primary corporate bonds, and the structured production such as the electronically traded funds. The American Stock Exchange was renamed NYSE MX after its acquisition. This market focused on listing and trading of smaller companies. Finally, the Arca Edge trader include the counter and the pink sheet stocks that are traded very inactively because of their low prices or low geographic interest. It is about over 2,300 different stocks that are listed and traded on the NYSE Euronext, and the daily average dollar volume of the trading in 2010 was around about $50 billion, or $69 billion shares were traded. So the trading process, let us explain that as well. All the transactions that occur on the NYSE occur at a specific place on the floor of the exchange, and that is called the trading post. Uh, each stock is assigned a special market, and that is called a specialist. So the market maker is like a monopolist with the power to arrange the market for the stock. In return, the specialist has an affirmative obligation to stabilize the order flow and the prices of the stock in times when market becomes turbulent. Uh, the specialist has an obligation to buy the stock to stabilize these prices. Because of the large amount of capital needed to serve the market making function, specialists often organize themselves as firms. Um, Specialist firms on the New York Stock Exchange range in size from 2 to 20 members, and specialist firms may be designated to serve as the market maker for more than one stock. However, only one special is assigned to each stock listed on the exchange. In general, because the specialists are obligated to establish the fair market price of the stock and must even occasionally step in and stabilize the stock prices. Underwriter investment banks, they are responsible for getting the best available price for their customers' new issue and are rarely allowed by the exchange to become specialists. There are then three types of transaction that can occur at this specific post. First, that brokers trade on behalf of the customers at the market price, or we can also call that the market order. Then secondly, there is a limit order, and limit order are left with a specialist to be executed. Then thirdly, specialists transact for their own account. These types of trades are discussed in more detail in the book, so one can read it from there. But let me give you some example. That is, as of December 2005, the trading licenses are needed to be makeable for the um, sorry it- I these trading licenses, these are made available by the means of Dutch auction. This is a type of auction through which a person this process which is called seeds, or we may also say the stock exchange auction trading system. In this type of auction, only a member organization of NYSE is eligible to bid for the 1,500 available trading licenses. Now, each trading license entitles its member organization holder to have a physical and electronic access to the trading facility of the NYSE. Trading licenses are then sold at an auction and are good for 1 year calendar only. So generally, when individuals want to transact to the NYSE, they contact their broker. Let me explain this process with the help of graph. Here we see that generally when these individuals want to transact on the NYSE, what they do is they contact their broker, such as one of the broker that might be the Wells Fargo Security. Then the broker then sends these order to its representative at the exchange called the commission broker, or what we call the floor broker, uh, working, and they work for themselves to conduct the trade with the appropriate specialist or a market maker in the stock. Then large brokerage firms generally own several trading licenses on the floor and are filled by their commission brokers trading orders from the firm's client or its own accounts. One of the specialist jobs to execute orders for the floor commission broker. However, these brokers can transact at a post with others without specialist participation. Specialists participate in only about 10% of all the shares traded. Also, orders are increasingly coming from public using online internet trading, and they usually bypass the commission broker and going directly to the floor broker. Once the transaction is completed, and it is generally in less than 15 minutes, the investor broker is contacted and trade is confirmed. Generally, the transaction is settled in 3 days. So this settlement is called usually and is denoted by T plus 3. That is, the investors has 3 days to pay for the stock, and the floor or commission broker has 3 days to deliver the stock to the investors broker. The vast majority of orders sent to floor or commission brokers are of two types, market orders or limit orders. So first we go with the market order. A market order is an order for the broker and the market specialized to transact at the best price available when the order reaches the post. The floor or commission broker will go to the post and conduct the trade. Before 2005, the best price placement that brokers were required to enter only with their very best bid and offer prices for a stock at a specific time into a public electronic database of stock codes. Now, then in 2004, the Security Exchange Commission proposed an overhaul of the rules that radically altered the way the best prices would be established. Brokers seeking the best price on a trade would have to enter all their bids and offers for a stock into a public database. This would enable other brokers who wanted to fill orders, including large block trades or sweep all markets for the best prices, and to simultaneously execute trades in the same stock across different markets. The so-called intermarket sweep would allow brokers to pick off the best prices among all accessible quotes. So a customer, like an individual investor who want to buy shares of a stock, could get chunks of that order filled at the best price across the various markets. This change introduces more computerization into the trading process, and this also reduces the amount NYSE trade conducted via the auction system overseen by the specialist firm. Second type that we have is a limit order. A limit order is an order to transact only at a specified price that we call the limit price. When a floor or commission broker receives a limit order, he or she will stand by the post with the order if the current price is near the limit price. When the current price is not near the limit price, a floor or a commission broker does not want to stand at the post for hours and even days waiting for the current price to equal the limit price. On this single limit order, in this case, the floor brokers enter the limit order or the order book of the specialist at the post. Now, the specialist who is at the post at all times when the market is open will monitor the current prices for the stock and conduct the trade when and if it equals the limit price. Some limit orders are submitted with time limits. If the order is not filled by the time or date of expiration, it is deleted from the market maker's book. Now, the third type of trade of that of a specialist trading is for his or her own account. There is a link between a market order and a limit order. When a market order is placed, the transaction occurs at the current market price, determined by the intersection of the investors and aggregate supply and aggregate demand for that stock. Let's say if the limit order is placed at, for example, 97.6 per share. So it differs from the current market price. The order is placed on the specialist book. And if it doesn't differ from the market price, then the transaction will occur at that simultaneous time. So the point is, if supply or demand conditions change, then in such case the market price falls to, let's say, 97.6 per share. The specialist completes the limit order, and then the specialist notifies the floor broker who submitted the order. Preferred stock. A preferred stock is a hybrid security that has characteristics of the New York Stock Exchange has defined program trading as a simultaneous buying and selling of the portfolio of at least 15 different stocks valued at more than $1 million using computer programs to initiate the trade. For example, program trading can be used to create portfolio insurance. A program trader can take a long position in the portfolio of a stock and a short position in a stock index future, uh, and should be the market value of the stock portfolio fall. These losses are partly offset by the position in the future contract. The timing of this trade is determined by the computer program. Program trading has been criticized for its impact on the stock market's prices and increased volatility. For example, on May 6, 2010, the financial market experienced a brief but severe drop in the prices, and the market fell by 998 points, that is more than 5% in a matter of minutes, only to recover a short time later. So the original focus was that the computer trading, coupled with the market's complex trading systems, triggered the free fall that appeared to have begun with an order to sell a single stock, and that stock belonged to the Procter and Gamble. A few days later, the fall was attributed to a $7.5 million hedge fund trade placed for 50,000 option contract in the Chicago option trading pits. Another potential culprit was the so-called fat finger error, when a Citigroup trader accidentally entered a sell button, accidentally entered a sell for billion size trade when he was meant to enter million size trade. So the regulators eventually found no evidence that the fall was caused by erroneous orders, computers hacking, or any terrorist activity. Rather, the flash crash was attributed to trading by a little-known mutual fund, which was located in the Kansas City, called the Asset Strategy Fund. So, a fund trader triggered the fall with the sale of $4.1 billion of future contracts linked to the Standard and Poor 500 index. The trader used a computer algorithm that tied the sale to the market overall volume. So trading volume soared on the 6th May, and the sell order was executed. While similar trades has taken several hours to execute, this trade was executed in 20 minutes. Regardless of how this historic drop started, it was exacerbated by computer trading. So the initial triggered pyramid effect from computerized trading program designed to sell when the market moves lower. As a result of potential for increased volatility created by program trading, the New York Stock Exchange introduced trading curbs, or that we call the circuit breakers on trading. So circuit breakers are basically limitation placed on trading when the Dow Jones Industrial Average falls significantly. So these circuit breakers are an imposed halt in trading that gives buyers and sellers time to assimilate incoming information and make investment choices. Circuit breakers promote investors' confidence by giving investors time to make informed choices during periods of high market volatility. So, for example, the circuit breakers for the third quarter of 2010 uh, The trigger point for these trading curves were lower after the 6th May of 2010. In the late 1980s, about 15 million shares were traded per day on the New York Stock Exchange as a program trade. In 2010, over 27% of the average daily volume involved program trading. The most active program traders are investment banks such as the Morgan Stanley, conducting trades for their own accounts or for those of their customers, such as the insurance companies, hedge funds, and pension funds. So much of this program trading involves index fund, uh, that is, for example, Vanguard 500 index fund, which seeks to replicate the Standard and Poor 500 index, and futures contract on various indexes. Investment in these index funds grew in 1980 through the 2000 as a result of the relatively poor performance in terms of return of specialized mutual funds and the strong performance of the major indexes. Controversial practices taking place in the stock markets, and these are called the flash trading, naked access, and dark pool of liquidity. Flash trading is controversial practice in which for a fee traders are allowed to see the incoming buy or sell orders milliseconds earlier than the general market traders. With this very slight advance notice of market orders, these traders can conduct a rapid statistical analysis with the help of powerful computers and carry out high frequency trading, which involves a very short holding period ahead of the public market. So critics contend that the flash trading creates a market in which certain traders can unfairly exploit others. Exchanges claim that the flash trading benefit all trades by creating more market liquidity and the opportunity for a price improvement. In September 2009, the Security Exchange Commission proposed banning flash trading. However, as of August 2010, the proposal has not been implemented. Most flash trading programs have been voluntarily stopped. Then we have another type of practice that is called the naked access. Naked access trading allows some traders and others to rapidly buy and sell stocks directly on the exchanges using brokers' computer code without exchanges or regulators. And The firms, usually with high frequency traders, are then able to shave microseconds from the time it takes to trade. A report says that 38% of all US stocks trading is now done by the firms that have naked sponsored access to markets. So the Security Exchange Commission, fearing that firms trading anonymously in this way could trigger destabilizing losses and threaten market stability of its rapid-fire trades, go Auri it has proposed to ban the naked access trading. However, the proposal has yet to be implemented. Then we have a third problem, that is the dark pools of liquidity. These are trading networks that provide liquidity, but they do not display trades on the order books. So this is useful for traders such as the institutional traders who wish to buy and sell large number of shares without revealing their trades to the overall market. Dark pools trading offers the institutional investors many of the efficiencies associated with the trading on the NYSE or Nasdaq, but it does not require that they show their transaction to the others. Dark pool trades also record to a national database. However, they are recorded as over-the-counter transaction. Therefore, the detailed information about the volume and type of transaction is left to the trading network to report to the clients if they desire so. And dark pool trading has been criticized unfair. With dark pool trading, traders who use trading strategies based on liquidity do not have access to all trading information. Another important market in the US is the Nasdaq. We will cover two parts of Nasdaq over here. One is the choice of market listing, and the other one is the electronic communication network and online trading. So The first one, coming to the first heading, that is choice of market listing. Firms listed with the NYSE Euronext market must meet the listing requirements of the exchange, and these requirements are extensive and can be found at the websites of the exchanges. So basically, the qualifications are based on such characteristics as a firm market value, earnings, total assets, and the number of shares outstanding, and the number of shareholders and trading volume. So there are several reasons that NYSE listing is attractive to a firm: improved marketability of the firm stock market, publicity of the firm, which could result in increased sale, and improved access to the financial markets, as firms find it easier to bring new issue of listed stock to the market. An IC listed firm must also have its securities listed regional exchanges. Firms that do not meet those requirements for NYSE Euronext exchange listing trade on the Nasdaq. Thus, the most Nasdaq firms are smaller, of regional interest, or unable to meet the listing requirements of the organized exchanges. Many Nasdaq companies are newly registered public issues with only a brief history of trading. Over time, many of these apply for NYSE listing. Not all companies are eligible to be listed on the NYSE actually, but some companies, for example Microsoft, believe that the benefits of exchange listing improves the marketability, and they are not significant. Others prefer not to release the financial information required by the exchange listing. Then, about the electronic communication network and online trading, the most markets that currently open at 9:30 a.m., and that is Eastern Standard Time, and they close at 4 p.m. again Eastern Standard Time. The extended hours trading involve any security transaction that occurs outside these regular trading hours. So almost all the extended hours trading is processed through computerized alternative trading system, which are known as ATS, and they are also known as electronic communication networks, which are shortened as the ECNs. So basically, when you are not able to, when or the investors, they are not able to trade on the regular market, they can trade on these systems out of the official hours. ECNs, they are computerized systems that automatically match orders between the buyers and sellers and serve as the alternative to the traditional market making and the floor trading. They are also the major vehicles for the extended hour trading, and ECN account for approximately 38% of the all Nasdaq transaction and almost all the extending hours trading, which averages to round about somewhat 70 million shares per day. Pakistan Stock Exchange, which is which was previously three independent stock exchange. They were present in Karachi, Islamabad, and Lahore. Now they have been combined into a single market that is called the Pakistan Stock Exchange, and basically Karachi Stock Exchange took over the Islamabad Stock Exchange and the Lahore Stock Exchange. Combining all these three, we now get a single stock market for Pakistan. So that's all about the stock market chapter. If you have any question, please do ask.